Well, the markets have a constant knack of humbling investors and traders. And after a 6% rally in the S&P and 7% rally off the lows in the Nasdaq as well, names like Tesla having a 30% rally off the March lows. Well, the sellers are back in control, and we're seeing a reversal in the tape and a slight pickup in volatility as we're getting headlines coming through about 25% tariffs coming through on US autos, 20% on European autos as well. And certainly the market is very much on the situation of looking at noise and headline risk as we go into Liberation Day, or the so-called Liberation Day on the 2nd of April. And this is something that we're going to have to contend with, an absolute headline fest playing through. Obviously, that's not for everyone, but we are seeing heightened risk coming through in markets and de-risking coming through. Now, of course, we are looking at the US dollar. We're looking at global equities, US equities in particular, looking at gold, we're looking at rates, looking at the commodity trade, all in the trade-off today. Let's get involved. Well, hi there, I'm Chris Weston, Head of Research at Pepperstone. We're joined in 2 seconds by Blake Morrow from Forex Analytics, and we will be discussing all the factors that are going on in the market, the headline risk playing through, what tariffs mean for you and the markets, and ultimately what's happening with the various trades that are in front of us, in front of radar, and where we think markets could be going in the short term. Mr. Blake Morrow, please come into the program, my good sir. Well, hi, Blake. So an interesting one at the moment because, obviously we've got so much headline risk breaking. I mean, I know that you look at sort of, you're more of a discretionary trader, but you do look at headline risk and you do react to them, and you make, try and make informed decisions around what's going on there. But I think for me, this is one of those situations now where it almost it's not even worth looking at the headlines, because there are going to be so many different things coming through, across all different geographies, towards China, Europe, different. We've seen auto tariffs coming through, but they could be on copper, they could be on all these different things, and we don't know when they're going to be implemented, how they're going to be implemented, whether that's going to be the final one. And so trying to keep up with all these and react faster anywhere near is what the algo is going to do. For me, this is just a question of, I mean, it was fine if there was one or two coming through, but there's going to be so many that it's just worth staying out and just waiting for the reaction from price and letting the market show you how the collective wisdom is seeing in interpreting this and believing it, and reacting to just the pure price. The price is the only fundamental. How do you feel about that statement, and how do you feel about it?
Well, thanks for having me on, Chris, once again. And we're just coming off of like news, the auto tariffs being announced by President Trump. So obviously the headlines are coming fast and furious. Prices reacting, and I think you're right. I mean, you have to look at price. It's obviously the aggregator of everything that we're currently seeing right now. But I definitely am trying to pay attention to every news conference that he's having, especially ones that are surrounding tariffs. I know we're going to talk more about tariffs as the show goes on, and as we get into some of our central topics. But the headlines are coming fast and furious, and you got to be ready, and you got to be willing to be prepared. And I think, as you pointed out regarding price, I think you have to have an open mind and understand there can be something that hits the market that could dramatically change the way that the whole market is viewing at an asset class at any given time.
And I think it also makes a key consideration for our ability to price risk. And do you want to hold risk and your positions and be overly exposed when you're not in front of the screen, and be able to look at those positions, and what does it mean for position sizing? So all of those factors are obviously very prevalent as well. Anyway, let's go to see what's how we're seeing markets in Topical Thunder. Well, let's start big picture market moves. Obviously, one of the factors we are looking for is what's happening in US equity indices, European indices, and the equity space. But you can take it out more broadly, and obviously looking at the dollar and rates and all those factors. But I think one of the factors for me is what happened overnight. We have seen 6% rally off the lows in the S&P futures, 7% in the Nasdaq. Names like Tesla, 30% off their lows. And I think the bulls are getting a little bit excited that we could see more of a move higher. Now, I'd sort of put the large amount of that rally down to short covering, and a lot of, as the market moved out, we did see a lot of sort of systematic funds who were short the market looking to cover some of those shorts. Some of the dealers post OPEX having to manage their inventory of S&P shorts as well and close those back. They didn't want them. And so it was more of a sort of a technical move up and a flow-based move up rather than people pinning their ears back and saying, are we all organic buying? We saw that in very light volumes taking place in the buying on the way up. But now we've seen the market roll over. And again, as I say, we've got the market it does seem to humble itself. Just as you think, we're out of the woods, bang, market rolls over. And that's where we are. So, how are you seeing the balance of risk in US equities short term? I think I'll start there because we're going to sort of touch on some of the other factors. But, are we trading lower? Do we roll over? We don't really know. We're going to see sort of choppy sideways trading. What's your sort of short-term bias?
I'm glad you brought that up. And if you remember our chart from last week, or the chart that I brought up for my play of the day, actually was a bearish pennant. And we basically traded up at the very top end of that pennant for the last couple of days in the 200 DMA. And then today, obviously, we came sliding down. So I'm still looking at the market as more of a bearish setup overall. But there's other markets out there that are really screaming, and I think you're gonna be touching on a few of them here in a minute that are making moves that I don't know it could continue to impact other markets as well. As far as currencies go, I think currencies are very, how should I say, confusing at the moment. And I think most traders are thinking about quarter end, fiscal year end for Japan. You've got month end, obviously month end and quarter end flows that you got to deal with as a whole. And that's all coming up on top of these major tariff news on Liberation Day on April 2nd. So, with all of that, I think the currency market's, kind of, range bound at the moment, but stocks look like they're showing some signs of weakness, but it's not just a U.S. story, or maybe more is a U.S. story, because you still look at other markets and they don't look half bad. So
well, there'd been this kind of out of US into China tech, and I want to see in the short term whether that continues, because we've seen Nvidia roll over 5-6%, Tesla's back under pressure. We'll have to see how it reacts to these auto news. We've certainly seen a bit of selling in GM and some of the sort of domestic plays there. But will we now see if US tech rolls over again? Do we see people looking to buy back into China tech? I'm not so sure that's going to be the case this time, because ahead of the tariff risk, I think that's a big risk there as well. And I do think that some of the heat's coming out of European equity markets as well. So it feels like, in this situation when the unknown is known, like we know that there's going to be huge headline risk. I know Trump's saying that the market's going to be pleased by what they hear on the 2nd of April. I think it's more a question of live to fight another day. Let's keep the risk minimal. If we are going to buy risk, I think probably the best strategy for me right now is long short strategies. I like being long US bank, short regional banks as a trade. I like long. If I'm going to play long the S&P, short Russell as a trade as well. And so, I think there's a lot of sort of tactical long short strategies which work quite well in this market as well. So that's an interesting one. But we're coming into the eye of the storm where I probably think in a month's time, markets could be finding a really good buying opportunity once this all clears up. But there's going to be a lot to work for in the short term.
Really is. All right. Well, let's actually talk about Liberation Day, and let's discuss a little bit about the tariffs that we're dealing with right now. And as Chris and I were just discussing, just literally about an hour and a half ago, before we started filming, President Trump was talking about tariff announcements, going to put a 25% tariff on all vehicles that are not made in the United States. It should force some automakers to continue to put plants in the U.S. and build, if they're European or Asian or wherever, that they'll build more plants in the U.S. and this way they can avoid tariffs. We got a little bit of I didn't really get much clarity on auto parts.
Yeah, it did. It's including auto parts. I think that was going to be the thing that was supposed to be carved out, but I'm seeing that it's being included here. So
Okay, and so there's still you think about it, Chris. There's a lot of, I don't want to say misinformation. There is a lot of positioning back and forth, and you hear things and you get whiffs and headlines that the market might be able to receive this, and then President Trump announced that on April 2nd, on some of the reciprocal tariffs, people are going to be pleased that some countries are going to be pleased. He's going to be more lenient on certain countries than others. So it's going to be a really interesting next couple of days. And like I said, I'm kind of letting the market as much as I can dust everything off as we go into this week and as we go into the beginning of next week. I kind of plan to hit the ground running on April 2nd, April 3rd as far as trading goes. That doesn't mean I'm not trading. I'm trading a little bit lighter right now until we get all the information. But I wanted to ask how you view like the tariff situation, because so many people have thought, and you can see this, kind of the stock market scenario where, maybe these were more threats. There was more threats to get to the bargaining table. It looks like those threats are going to be a reality. Maybe he is going to be tariffing, and the stock market's kind of getting that feeling now. How do you feel about the whole tariff situation, and how should we approach it as traders?
I think it's ridiculously complicated from a perspective of reaction and interpreting the reaction. Right? There's not just the reciprocal tariffs, but there's reciprocal tariffs on GST and also VAT that we need to consider. And that was the controversial thing. There's the universal nature of this. Is it 10, 20%? There's specific countries and specific sectors. So there's going to be a lot of stuff. One suspects, you've got to consider, does he go in with his hardest possible gambit, which would make a lot of sense? We then go to a period of negotiation. Reciprocal tariffs, other countries will have to work out, do they want to lower theirs, or do you want to just capture what Trump's put in? How long does it get phased in one go, or does it get staggered? How is it passed? What is the countermeasure? We're already seeing for the Canadians now coming out as they've been very pointy in reciprocating, but the Canadians have all come out and said we're looking at countermeasures. Other nations may not. They may lower their tariffs. So it's all very, very difficult to work out, and there's a lot to price, and that pricing is probably about as cumbersome as I've seen in market pricing for a long time. It's really, really difficult to understand how you price this in, and therefore for me, I'm going to keep an eye on it, because I'm a sucker for punishment. But for the average Joe on the street, for the average retail trader, my advice is just don't even bother trying to stay up with this, because they're going to be coming in thick and fast. The first reaction may not be the right reaction. Liquidity is an issue. Positioning is obviously and just look at what the market pricing is saying, because that's ultimately what we're trying to interpret. We're not trying to interpret, remember, Blake, and you know this better than anyone else, but it's not about how we see tariffs. For me, it's not about how do I see tariffs impacting economics, impacting Fed meetings, Fed decisions. It's about how the broad collective see it. And we're trying to understand how the market interprets it. And that's what price action is about. So, stay out of the market. Well, don't stay out of the market. Stay out of trying to interpret that. Make your life a little easier and go from there.
Do you mind if I add just one last thing? Because you make such a great point. And especially where traders get in a lot of trouble are the ones that have been around for a while. The ones that have been around for nearly 3 decades, like, us. And you're like, well, the way the market should be thinking about it, you're right. The market's going to interpret how it's going to interpret, and right. That's the collective. But you're taking in all this information, and what you should be asking yourself is, could that move that you're seeing right now have some legs? Meaning, could it continue based on the information that you are looking at right now? That'll make you feel a little bit better about being long the euro or short the euro, for example. You're seeing the euro sell off, and you're like, does that make sense based on the information that I've just heard? And that might, again, help you, feel a little bit better about following that price.
Does it make sense to you? I mean, not everything makes sense, right? Because we're dealing with, because we're dealing with, it's not just about what we're not doing is everyone in the market is like us, right?
Yeah.
Everyone is a sort of a macro thinker, a trader like us or whatever. You're dealing with people looking to manage flows, a lot of systematic, zero DTE options playing through, there's all these different things which are moving markets, and it's not everyone was thinking like us. So that makes life even harder, right?
True. So I know we need to move along if we don't, our producers.
Yeah, well, let's move on to commodities, because this is something that is, really getting quite a lot of attention at the moment. Gold all-time high. We're not just off the not far off all-time highs. People saying it's a classic hedge. I mean, we can talk about gold till the cows come home, to be honest, because there's so much to think about. Yeah, positioning still pretty rich in managed money, 180,000 contracts, 76 percentile. Market is long, good hedge, but I think gold's probably best days as a hedge is about the fallout from tariffs and yeah, the idea that we could see higher stagflation risk and higher recession risk further down the line. And we go back to our friend tariffs here. A lot of the fallout from tariffs, the real fallout's not going to be actually implied in the data for some time, and that's something that the Fed, being a lagging indicator there, are going to be looking at. But gold's at where it is at the moment. It's holding above 3,000 quite nicely. Copper's just been on a rip-roaring trend, not because of the message that it's sending about global demand and global growth coming through, but because everyone's been moving their positioning out to the COMEX, and you've seen that arb between CME and LBMA, or sorry, the London copper blowing out extreme wides, and it's really been about this idea that you're going to get tariffs on copper, which have been rushed through at the moment and under the 232 executive orders. Copper's just been an absolute ripping trend. Then you got crude, which I'll talk about in a minute, which Trump wants crude lower, he's not getting it, and crude's been moving up again. So that's been a really interesting one. I feel there's probably a bit more juice to the upside, and that's going to clearly not infuse Trump. So what are you looking at? Which sort of have you been trading, if any?
Well, actually, you named all three that I've been really, really focused on. I think just for crude oil specifically, and I know you're going to get into it in a little bit, so make sure you all stick around for the rest of the show. I was looking at the first level on crude at 71.10. This is a 38% retracement, but you're right. It's not going down. And what is that going to do to inflation expectations on top of what we're seeing regarding tariffs? Now, I also am really focused on copper because copper did break out to all-time highs last night. If you've seen the recent, I want to say maybe last year, a year and a half ago, I have to go back and look at the charts. I don't have them in front of me. When copper broke out to new all-time highs, it failed and it rolled back over. I still think I'm telling you guys, because I've already told our community, I think the copper market's actually going to fail up here after these tariffs. After we get past April 2nd, I think it's going to end up being a false breakout. But my question is going to be, what's going to be the impact on other things as a result? And as you pointed out, gold is pinned to its all-time highs, and it's really at that point where we start to accelerate. And we start looking at big round numbers like 3,100, 3,200, 3,300. It just starts accelerating. You don't have extensions. You don't have technical targets you can really look at when it goes into an acceleration mode. Flip side is, it doesn't look bearish. It's not backing away. And so I don't know what the message is trying to send, other than there's a lot of uncertainty out there and there's no reason, because I still can't find one. And I know we've asked this on the show many times, Chris. I don't have an argument against gold. It's scary, but I don't. So
I think the argument against gold would be, we move past tariffs and equities rally and we see Fed rate cuts coming out of the market. I think that would be a reason to unwind, but we're not seeing that at the moment. Gold's holding on pretty well, but I think the copper thing's an interesting one, because I think that is setting up. I do agree with you, but timing, it's going to be absolutely critical, as it always is, because if we assume that it's going to be a 25% tariff on copper imports, like we saw with aluminium or aluminum and steel, then that arb that we're seeing out could blow out further, and that could continue to push upside. So I think this idea of selling the fact, once the tariffs kick in, I think there will be a time where we will see a big sell-off coming through in the copper market, but I don't think it's right now.
All right. Well, I'm gonna take that into account based on what I'm looking at and how I'm feeling in my gut, because my gut doesn't always lie, but it's big enough where I got to listen to it. So what can I say?
Well, my gut's feeling pretty good at the moment, because I'm back on the Vital Greens drink at the moment. So I'm feeling pretty healthy inside. A bit of Yakult as well, but doing it well.
Good, man. All right, let's get into our fourth topic before we just go on and on and on. And let's talk about what we're looking ahead into the second quarter. And not a palm reader or a forecaster, and can't tell people what when the next moon is. It's going to put an inflection point in the market. However, I can think about what is transpired right now and what the market should be looking at. I think, in my view, are going to be most important topics as we go into the second quarter. And I want to see if there's anything that I miss here. So first and foremost, let's talk about labor. We've seen these big cuts in Doge. Now, remember, labor is one thing that it's kind of like inflation expectations. It's more sentiment, right? If you start to see job cuts and then other which is a lot of the United States or small business, small businesses that have less than couple hundred employees. You have so many businesses are like, well, I don't think I want to hire either, and maybe I might trim a little bit. So it ends up being more of a sentiment thing, and that's why, considering what's happening with the private sector, and especially as those private sector employees go look for jobs, or government employees go look for jobs in the private sector, what's that going to look like, and how's that going to affect our labor market? And so we need to be paying attention in the second quarter. Inflation expectations, obviously with tariffs, we got to start thinking about inflation expectations. As you just pointed out, that could really put a crimp on consumer sentiment on top of what the stock market is doing. Third, thinking about the stock market, thinking about earnings, and obviously the Mag 7 is not so magnificent right now. It's actually opposite of that right now. So, what's the next earnings season going to look like for the market? And will the Mag 7 continue to underperform? Because the generals have been pow. They've been shot in the market. Usually when you take out the generals, that's when war's over, or in this case, game's over. So that's going to be the third thing that I'm going to really pay attention to. And the fourth thing is, what are going to be the effects of these tariffs? And, how is the market going to interpret it? And is Trump and the Trump administration really playing hardball, or are they going to continue to negotiate? I'm sorry, I talked almost the whole 3 minutes, but I want to make sure I got those points out there. Chris, please go on and tell us, what are you thinking going into the second quarter?
Earnings, I think JP Morgan kick us off on the 11th of April. It's hard to sort of argue any entry points. We move through the quarter. I think we want to see the data flow. Tariffs are going to be with us, and the tariff news flow is going to be with us for a period of time. But the market will get desensitized to it. Then it will be a question of how that sort of translates into the data. And of course, we will be watching how economic data comes in, whether business confidence continues to roll over, what happens to these job losses from Doge, and whether that manifests in the idea about stagflation risk. At the moment, the market's pricing about a 30% chance of a recession, something like that. Will that increase? And I think that's going to be the big macro forces. Is how much further can growth fall? Will it sort of perpetuate on itself? Will the Fed have to respond to that situation? What are corporates saying? There's obviously a lot. I think, but that will be the big issue for me is how business conditions affect to the fallout from tariffs. But then I think we start to move on to the debt ceiling. That's going to be an issue that we know how will resolve, but it will probably be taken to the wire again, and we could see some angst in the final days. Then I think we start to really think about these other fiscal measures, deregulation. We start to think about will tax cuts go through at the end of the year, and maybe we get a period of pain followed by a nice V-shaped recovery. So there's a lot, but I think the first one will be as we start to really sort of get to grips with tariffs, have a clear understanding of how that's all sort of perpetuating, and the fallout from data. How will that be seen? What will the impact be on inflation, business conditions, and how will the Fed have to step up and respond before we then move on to the next issues? So I think it's pretty safe to say that there's going to be a lot to work for in Q2. So keep watching the show. Anyway, let's go to that.
It's going to be a busy spring.
It will be. Yeah. Anyway, let's go to that's the setup. Well, I want to bring US 500 S&P up, because what I think is interesting here from the daily chart, you can see is that we did have a move up from those March 13th lows. We had about 6% rally into that situation. We had the gap up on the Monday open, and we can trade it up into the 200-day moving average. Actually, Nasdaq cash sold off pretty much bang to the T, as did Tesla. And we had a little bit of a move above there, which was shock. The market's been pretty happy to sell into that situation. So we're actually now testing Monday's low And that means that we've sort of run the risk of pulling into the gap. And the gap's obviously meant to be filled, but it's really what happens after that point, and that's going to be make or break. I mean, if once we get, you can see the sort of black horizontal line. If we're to make a move through that point, the gap's been filled, and that would then sort of take us lower, and that would sort of increase the risk that we do go back and test those lows. That's going to frustrate a lot of people who've been buying in that March run. Now, what we've seen overnight is a situation where I think some of the fast money longs who have been buying in that 6% rally on for a technical bounce have probably given up and taken some off. There's still probably a bit of legacy longs who failed to close out in the 9-10% rally or sell off that we saw February to March, and they've still got to take some off. So I think really for me is now, do we go down, firmly close the gap? Do we bounce off that gap low, or do we push through? Obviously, if we push through, that's for the people who do trade gaps, I think that would be a pretty telling situation. That would really increase the chance of us revisiting those March lows there.
Ooh, good one, Chris. I appreciate it, and I know our traders do too. Hey, so my first setup is actually going to be Bitcoin, and I've been talking about this, talking about a long-term distribution pattern in crypto. And we've had so many discussions here on the trade-off about Bitcoin and Ethereum and crypto just as a whole. Bitcoin's at a big inflection point right here. It's the 38% retracement. I would say channel resistance comes in right around 90,000, 90 to 91,000. I think that's where the rubber meets the road. You got the 50 DMA that's that moving average that you can see is coming right to where price is at. I think even a pop above that 50 DMA, you're going to be finding resistance right where I think is going to be that key inflection point. Watch the 90 to 91, 92,000 level. If we can push above that and we can start getting some daily closes above that, we might be heading to 100,000 again. But if we reject around these levels and that channel resistance, or from here or lower, I mean, just keep in mind, we're at a 38% retracement right now. That is a recipe for a continuation lower and to push us back towards the 74,000 major breakout point that Chris, you and I have talked about endlessly here. So I think you guys should be watching Bitcoin. I think it's a real pivotal level and it's a good setup. If you're looking to go long, you wait for a breakout. If you're looking to go short, you might have your price coming up soon. So there you go.
This was my play of the day last week, and it worked well for a while. We're still up couple of $1,000 from last week, which isn't.
Yeah, you were looking for the break above the 200 DMA, and we got it. It was great.
Yeah, well, so I mean, we closed out. I mean, it's had two lower highs now, so we're sort of out that one. It hasn't really done a huge amount. It's worked, but it's not really been as prolific as one would have liked. But obviously we don't always get what we want. But yeah, so I think this is one. I mean, it's just everything just works so well technically with Bitcoin. We had the range break in February. It traded literally down to double bottom, double top target. Now we're working in this channel that you put out, and it respects levels probably better than most markets. So, for the technical traders, it's a great market to trade. It's a great vehicle there. But I want to move on into the US recession. It's not a setup so much, but what we've done here, Blake talked about this idea about following inflation expectations. So these are a couple of charts that I'm watching very, very closely going into Q2. The first one is what we call the US five-year inflation swap. Now, that is essentially, if you're a hedging vehicle, you want to hedge out your inflation risk further down the line. This is 5-year expected inflation starting in 5 years' time. So effectively, we're looking at how our inflation is expected to average between 2030 and 2035. Basically, the Fed will look at this one very closely because this looks at the markets-based levels of expected inflation on a more forward-looking basis. Austin Goolsbee, the Chicago Fed president, talked about this yesterday in the FT. The Fed are looking at this. If tariffs really manifest into higher inflation expectations, if that top chart was to start moving up, pushing into 275, I think that's the market saying we've got an inflation problem. If people are worried about inflation, this is the chart to look at. Now, that would be so that if this does move higher, that is the chart to see the Fed reacting much more hawkishly and seeing a stagflation risk. The bottom one, though, I think is another one we're looking at very closely, which is the market's anticipation of where the Fed could get to in its cutting cycle. So this is what we call the terminal rates pricing. The white line there is 3%, which is essentially the Fed's longer term neutral rate. So what I'm trying to do with that bottom one is trying to understand where the market's anticipating the low in the Fed cycle. Well, I've got that white line is just to say, if it goes through 3%, that is the market saying we're on recession watch. The Fed have had to move it through a neutral capacity into a more stimulatory environment. And I think that's where you start saying that is the market, the equity market and the rates market, pricing in a much higher recession risk and the Fed needing to stimulate and go into a more dovish style. So the top one for me, anyone looking for this idea about inflation being de-anchored and people seeing that, well, that's the top chart. And that would lead to a bigger de-risking in markets. And the bottom one is the market then saying, this is the Fed now having to stimulate. And that's something we're not there at the moment. Markets are at 3.55%, but a break of 3% in the future, maybe into late Q2, is the market saying that recession risks on. These are my guides, I think, in that situation.
Wow, those are great charts. As you said, it's not a setup per se to trade, but boy, what a great place to.
I think it's a great guide for me. People saying, "Oh, inflation's going to ramp up." Well, the Fed are looking at this top one, saying, "Well, at the moment, we've seen some red flags in some of the survey-based data. You've seen that in the Philly Fed numbers. Prices paid have ballooned up. The New York Fed numbers have ballooned up, but the new order subcomponent have gone down. So that the survey-based levels have shown sort of stagflationary concerns, but the inflation expectations in at least in the long term in market eyes are not concerned at the moment. So the Fed will look through everything on tariffs unless this becomes de-anchored and we see that spiking up. Then the Fed will take action."
Keywords of out of Chris Weston's mouth at the moment. All right.
At the moment, yeah.
At the moment. All right. So my last setup is actually a chart, and this is actually a trade setup. It's going to be the Euro Aussie. Now I'm gonna pick my words carefully here because I know we have a very Aussie heavy and Asian heavy audience. So don't take any offense to any of this. But the Euro Aussie actually looks like a pretty darn good long-term setup. And I have to think, I try to think of myself as like an asset manager that maybe, I'm long a bunch of Aussie dollars. I'm more heavily positioned to Aussie dollars versus other currencies because China's rallied, risk has bounced back. We saw a sell-off in the broad-based dollar market, even though it wasn't broad-based, but, it was more Euro, Sterling, European heavy. But we saw this big move down in the dollar and it looks like it's kind of stalled, but the Aussie hasn't moved anywhere. The Aussie is trading heavy. And it's actually, I'm not even going to pull up the Aussie US dollar chart, but it is in a bear flag pattern, just so you guys know. Europe, on the other hand, there's this spending that's going to come through Germany. Probably going to see more in France, more in all European countries as they try to gear up from defense spending or whatever. Ultimately, is it going to be good for the euro and the debt that they're piling on? Maybe not, but for right now, it could be a euro tailwind. And I think this is a good setup for a potential risk-off move where you have the euro outpacing the Aussie. So I'm looking at this 38% retracement here, which is the flag pennant bottom. Comes in around 170. As long as we stay above the 170 level, I think it's still potentially a bullish setup. We break below 170, we might trade down to 168 or the 50 DMA at that green horizontal line that you see down there. But I think this is a good setup. Not, however you want to approach it. I think that this is one worth watching.
I love these. I love those patterns, to be honest. And 70-80% of the time they break out so the direction of the primary trend.
Continuation, yeah.
Yeah. So I mean, if you draw the flag on that, draw the pole on that you've got a pretty decent upside. But obviously, when do you trade it? You trade it when the market says there's a chance for conviction. So it's a setup. Wait for it to complete, and then you're getting a high risk, a high probability outcome from that. But I think it's one of those things where I think a lot of people saying, well, I don't really like the euro, I don't really like the Aussie, to be fair, but the market will do what the market wants to do, and that setup is I think is one of my favorite ones, and that continuation of the trend I think is a good one. So definitely one to bring on the radar, worth putting on. Thanks, Blake. Let's go to play of the day. I want to have a look at Euro Stocky. Interesting one because it is absolutely getting tailed up at the moment. This is one that the momentum heads have really been looking at. One of the trend followers. It's the Stocky is the performing currency of 2025. It is in G10. There's nothing really that comes close. It is the performer. Everyone was saying the yen would be, but it's actually the Swedish krona, which is the best performing currency in G10. So people love to be attracted to what's strong. I want to sell rallies in this one. I think we're going to probably get a little bit of massaging coming through. But yeah, the problem in Sweden, or the thing in Sweden, is they are the forward-looking indicator. They've got the economy that the Europeans generally sort of follow. I know it's a very different economic beast, and you've got one country against 19, so to speak. But the forces that they have in Sweden generally are then reciprocated in Europe. And what we're starting to see now in Sweden is, they've done their rate cuts. The rate cuts are all over. They're firmly on hold. In fact, they're now saying they've got an inflation issue playing through, and that's causing good upside in the stocky. So growth's an issue. You saw seeing some concerns around growth in Sweden again. But we do have sticky inflation, and that means that the Swedish Riksbank are not going to be cutting rates anytime soon, as opposed to what we're seeing in Europe, which obviously has concerns around what's happening in tariffs, which they still need to work through. We've got an ECB which meets on the 17th of April, and they probably will cut rates. So there's a 75% chance they'll cut rates. So it's not fully priced in. And I still think there's a lot of people working out the ECB's terminal rate, which at the moment, we're sort of expecting that to come down to sort of 2%, which I think there's probably downside risk to this. So, I think this is a momentum juggernaut, bit of heat coming out to it. I'm selling into this. The market loves the stocky story. There are risks, but I think, selling into Euro stocky makes a lot of sense here.
That's a hell of a trend, Chris. Hell of a trend. Yep. Selling rallies in the Euro stocky. I like to drink the Naki stocky, but the Euro stocky, that's a good one. All right. My play of the day is going to be the dollar index. And, pick your poison here. But the dollar index is coming up to what I call a triple confluence. Not only is it a 38% retracement of the last move lower. When I say the last move, I'm talking about basically the February highs all the way to the trend lows. But it's also the 24% retracement of the highs that we saw back in December, January, and then to the trend lows. Also the 200 DMA, which gives it a triple confluence. So that level comes in around 104.88. I would say that equates to around 107 in the euro. And guess what? We could probably see 107 in European trade overnight based on the headline news that we just got, all the tariff news. There's a good chance that we could trade around 107. But just keep in mind, if you are trading around the euro dollar, the dollar index is going to be right at that triple confluence. And I think this move has been so impulsively lower from an Elliott wave point of view. I think you want to be selling rallies, Chris. So this is giving you that look to sell into, in my opinion. So
yeah, the tariff thing's so interesting because everyone, all the sell side analysts were saying, tariffs are going to be so good for the dollar, and while they haven't been as aggressive, the dollar's just getting no love from tariffs at all. And again, it just comes to the idea of being open-minded. If things don't do what they're supposed to do, you just got to follow the market and understand why the market's thinking that way. Maybe tariffs do manifest into a stronger dollar. I still think the Chinese are very important in this situation, and if we were to see something hit them, which means that they start to devalue and push dollar CNH and CNY higher, I think that would then push the dollar higher until such time it's not really working. The dollar's not getting huge effects or having any real effect to tariff news at the moment.
Right.
Yeah. Anyway, thank you, Blake. Thank you very much for joining us and sharing your insights. And for all you ladies and gentlemen at home, thank you for watching. And leave your comments below. Let us know how you're trading the market. Click the like button, subscribe, and we'll see you back next week.